Gold should be obsolete right now. Maybe not completely worthless, but its special role in the world of money should have ended decades ago. Because when the gold standard disappeared, the world technically replaced it with fiat currencies. And those currencies don't need gold to function. But still, central banks and other official institutions hold roughly 38,000 tons of it. Investors still rush to gold when financial markets get shaky or geopolitical tensions rise. Like when a certain orange haired dude might start, stirring things up again, which creates a strange contradiction. The very institutions that are running a monetary system that no longer needs gold still seem to believe gold is worth owning. And this becomes even stranger when you look at everything else humanity has tried. Silver functioned as money for centuries. Governments tried combining silver and gold through bimetallism. And now Bitcoin is trying to bring some of those same properties into the digital world. Different systems, different technologies, and different periods of history. Yet gold keeps surviving. And that leaves us with one question. Why is gold still the standard when there is no gold standard anymore? To get an answer to this question, I started mining. Not for gold, for information. In this gigantic mine called the internet. And pretty quickly I ended up in 1958. That's when the Bretton Woods system finally became fully operational. So, this system is basically foreign governments and central banks could take their dollars to the US and exchange them for gold at $35 an ounce. So foreign central banks now had a pretty good reason to hold dollars, because at least for them, those dollars came with a promise. Bring them back to America and you could get gold. By the late 1960s, there was a problem. The world was holding more and more dollars, while America's gold reserves were running dry. And countries were starting to test whether the US could actually keep its promise. They started exchanging those dollars for gold, which meant even more gold leaving American vaults. And there's even more pressure on the system. Eventually, the Bretton Woods arrangement became really hard to maintain. So on August 15th, 1971, Nixon suspended dollar convertibility into gold. By 1973, Bretton Woods had effectively collapsed. And by 1976, IMF members met in Jamaica and went even further. They agreed to remove gold's official price and push it out of the center of the international monetary system. So they were deliberately removing it from the money's throne. But here's the weird part. Remember those 38,000 tons from earlier? Those aren't just leftovers from some ancient monetary system that central banks forgot to clean out. They're still buying more. In 2022, central banks purchased roughly 1,082 tons of gold. 2023, another 1,037 tons. 2024, another 1,092. And in 2025, roughly 863 tons. So think about how ridiculous this is, right? Governments spent decades reducing gold's role. They removed convertibility. They dismantled the system built around it. They eventually created currencies that could function perfectly well without it. It's almost like they tried every possible way to make this shiny metal unnecessary. And then they kept buying it. Which suggests something important. Maybe gold survived not because humanity couldn't come up with alternatives. We came up with plenty. Maybe gold survived because every alternative eventually ran into some problem that gold was unusually good at avoiding. And once I started looking at those problems, 3 of them kept showing up again and again. The first one appeared with gold's oldest rival, silver. Silver seems like it should have worked. In fact, for centuries it worked really well. It was scarce enough to hold value, durable enough to survive circulation. It was also divisible into coins and far more abundant than gold. In many ways, that abundance was actually useful. There was simply more silver available to function as everyday money. But that also created a weakness. Like in the 16th century, enormous deposits such as Potosi dramatically increased the amount of silver entering global markets. Centuries later, the Comstock lode was discovered. It created another major surge in production. Basically, the world is using silver as money, and suddenly they're pulling enormous new quantities of it out of the ground. If supply expands much faster than monetary demand, that starts putting pressure on silver's scarcity. And governments created another problem when they tried using silver and gold together. Under bimetallism, governments legally fix an exchange rate between the two metals. In the United States, the ratio sat around 15 or 16 ounces of silver for 1 ounce of gold at different points, which sounds reasonable, until the market decides the metals aren't actually worth that ratio. If silver was officially valued higher than it was in the market, people had a reason to bring silver into the system and take gold out. If gold became legally overvalued instead, the opposite happened. One metal would flood into circulation while the other disappeared into hoards, exports, or melting pots. The government could fix the ratio. It couldn't force the market to agree with it. And that reveals the first major problem any monetary commodity had to survive: the scarcity manipulation trap. It isn't enough for an asset to be scarce, its monetary supply also has to be difficult to suddenly expand, distort, or overwhelm. Because the moment people stop trusting the scarcity, they start questioning the money built on top of it. But even if you could perfectly protect an asset's scarcity, there is another problem. What if using the commodity destroys it? And for that, we need to talk about oil. After Bretton Woods collapsed, oil became even more important to the dollar-based global economy. Most international oil was priced in dollars. And after oil prices exploded in the 1970s, producing countries suddenly accumulated enormous amounts of those dollars. This is where the famous petrodollar story comes from. And you've probably heard the simplified version. America replaced gold with oil, Saudi Arabia agreed to sell oil only in dollars, and that's what kept the dollar alive. Except that's not what really happened. Oil never backed the dollar. There was no promise that you could take your dollars somewhere and exchange them for a fixed quantity of crude. And there wasn't some worldwide rule forcing every barrel of oil to be sold in dollars. What dollar-priced oil did do was reinforce demand for dollars. If countries wanted to participate in a global commodity market heavily priced in dollars, having access to dollars was useful. But that's very different from oil actually becoming money. And even if we tried using oil that way, it has one massive problem. We burn it. Every barrel used for transportation, electricity, or industry disappears from the available stock. A country can stockpile millions of barrels, but maintaining that stock requires continuous production, replacement, and storage. And oil isn't unique, like grain can be valuable, it can be traded, it can even be stored for a while, but eventually it gets eaten or spoils. Many commodities face the same problem. Their economic purpose involves consuming the thing itself, which creates the second trap, the consumption trap. A commodity can be scarce, valuable, and globally important, but if normal economic use continuously destroys its existing stock, preserving that commodity as monetary wealth becomes much harder. And solving scarcity doesn't solve this problem at all. The third problem is the trust trap. And unlike the first two, this one really isn't about the physical properties of money at all. It's about what happens when money stops depending on a commodity and starts depending on institutions. That's essentially what fiat money did. A dollar doesn't need to contain gold. It doesn't need to represent silver or be backed by oil, grain, or anything sitting in a vault. It works because people trust the system behind it. Governments accept it for taxes. Businesses accept it for goods and services. Banks settle transactions in it. Central banks manage its supply. And everyone expects everyone else to keep accepting it tomorrow. And for the most part, this works incredibly well. Fiat money solved problems commodity money could never solve. But it also moved the foundation of money from the asset itself to the credibility of the institutions managing it. Most of the time, nobody thinks about that until confidence starts to weaken. Inflation, banking crises, debt problems, political instability. In these situations, people slowly start wondering if the system propping up the currency is actually as stable as they thought. They lose their trust in it. And that's what makes the trust trap different. Trust has to be maintained continuously. Because once an asset depends on institutional credibility, its value is always tied to at least some extent to whether people continue trusting those institutions. And for some reason, across thousands of years, gold proved unusually difficult to break with any of these three problems. The difference is so basic that it almost feels obvious. Just like silver, gold is also mined. Of course, gold also had its own massive supply shocks. The California gold rush, the Australian gold rushes, the enormous discoveries in South Africa. All of them dramatically increased gold production. And yet none of them permanently destroyed gold's monetary role. The reason comes down to one unusual advantage. There's an enormous amount of gold above ground. So every year, new mines aren't creating a whole new supply of gold. They're adding a small amount to the enormous pile we've already built up over thousands of years. And that difference matters. So imagine a commodity has 100 units in existence, and miners suddenly produce another 20. Its total supply just increased 20%. But if 10,000 units already exist, producing another 20 barely changes anything. Gold operates much closer to the second situation. The World Gold Council estimates roughly 220,000 tons of gold exist above ground, while newly mined gold expands that stock by only around 1.8% per year. And increasing the production isn't particularly easy either. Higher gold prices can encourage more mining, but new deposits still have to be discovered, financed, permitted, developed, and extracted. That process can take years. And this is how gold counters the scarcity manipulation trap. That massive existing stock acts almost like a buffer. A new discovery can increase production. It just can't easily rewrite the scarcity of the entire asset. And strangely enough, the reason gold was able to build such a massive stock in the first place is also how it escapes the second trap. It's the fact that gold doesn't really disappear. The gold mined hundreds of or even thousands of years ago can still exist today in almost exactly the same form. It can be worn as jewelry, stored inside a vault, melted into a bar, turned into coins, and then melted down and used all over again. The owner changes and the form changes, but the gold itself remains. And that gives it a massive advantage over commodities like oil. Oil can be stored for years, it can be incredibly valuable, but eventually its economic purpose is to be burned. The moment that happens, that barrel is gone. Gold works almost in reverse. Using gold as a store of wealth doesn't consume it. Transferring it doesn't consume it. Even reshaping it doesn't consume it. Which means humanity doesn't need to continuously mine enough gold just to replace what disappeared last year. New production simply gets added on top of centuries of existing production. Some gold is still lost through industrial use or becomes uneconomical to recover. But compared with commodities whose normal use destroys them, those losses are relatively small. And that solves the second trap. But durability still can't solve everything. Because an asset can survive for thousands of years and still depend on someone else keeping a promise about its value. And this is where gold's third advantage becomes almost the opposite of fiat's strength. You might remember from earlier, fiat works because an enormous system of institutions stand behind it. But gold works because it doesn't need one. Once you own physical gold, you don't have to rely on anyone else to honor a promise. The price can rise or fall, of course, but the asset itself cannot default. And that becomes especially useful when what investors are worried about is the system itself. When people lose confidence in those institutions, gold offers something that's surprisingly hard to find. An asset that can preserve wealth without depending on the very institutions you're worried about. And this becomes even more important for central banks. If a central bank holds another country's currency or debt, it's still depending, at least to some extent, on that country's monetary or political system. Gold, held in its own reserves, is different. It becomes a reserve asset that sits outside another nation's monetary system. That's how gold counters the trust trap. Of course, people still have to trust its authenticity, custody, and market value, but its value doesn't depend on a specific issuer continuously maintaining credibility. So if these three properties explain why gold works, they still don't explain why gold won. Because none of those things are completely unique to gold. Silver is durable too. Platinum is even scarcer. And Bitcoin arguably takes some of these ideas even further. Its supply is programmed, and it isn't consumed, and it doesn't require a central bank to issue it. So if those three advantages were enough, why gold? Why didn't another metal or even digital currency eventually take its place? And why, even after governments removed gold from the center of the monetary system, did they continue coming back to the same asset? Because gold has one advantage none of these properties can create overnight: history. Humanity has been treating gold as wealth for thousands of years. And over that time, we didn't just accumulate gold, we accumulated an entire system around it. Standardized weights and purity, deep global markets, vaulting infrastructure, bullion dealers, financial contracts, central bank reserves, and generations of institutions that already know how to value and store and trade it. This creates something economists call path dependence. Once the world spent centuries organizing around one monetary asset, replacing it means doing more than finding something with better properties. You have to replace everything built around it too. And that's much harder. Because a new asset can be scarcer than gold. It can be easier to divide. It can be faster to move. It can even solve problems gold cannot. But gold doesn't have to convince governments, banks, or investors that it could function as a monetary asset. It already has, again and again. Through wars, currency collapses, political regimes, different monetary systems, and even the death of the gold standard itself. which means gold's greatest advantage today might not actually be something found inside the metal anymore. It may be the thousands of years humanity spent building around it. And there's probably no better way to test that idea than with the first serious challenger that doesn't need to be a metal at all: Bitcoin. And Bitcoin is interesting because on paper it solves a lot of the same problems gold does. Its supply cannot simply be increased whenever demand rises. It isn't consumed when people use it, and there is no central bank or government issuing more of it. In some ways, it even improves on gold. Bitcoin can move across the world far more easily. It can be divided into incredibly small units. It doesn't require ships, armored trucks, or enormous vaults to transfer from one owner to another. So if the three traps were the entire explanation, Bitcoin should already look like a better version of gold. But there is one thing Bitcoin cannot manufacture: time. Gold has spent thousands of years being treated as wealth. Governments store it, banks trade it, and markets have standardized it. As you already know now, entire monetary systems have been built around it. And even after those systems disappear, the infrastructure and recognition surrounding gold remained. Bitcoin has had only a fraction of that time. It's still far more volatile. Central banks have not adopted it as a reserve asset on anything close to gold's scale. And we still don't know how deeply it will become embedded in the global monetary system over the next several decades. That doesn't mean Bitcoin fails. In fact, the fact that it can even be compared with gold tells us something important. Because Bitcoin is essentially attempting to recreate digitally many of the advantages that made gold useful in the first place: scarcity that is difficult to manipulate, an asset that isn't consumed, and wealth that doesn't have to depend entirely on a government issuing it. So if Bitcoin eventually succeeds, it won't prove that gold was obsolete. It may prove the exact opposite. It would show that the functions gold provided were valuable enough for humanity to try rebuilding them in software. And if Bitcoin fails to replace gold, that tells us something too. Maybe scarcity isn't the hardest thing to reproduce. Maybe portability isn't. Maybe divisibility isn't. Maybe the hardest thing to reproduce is thousands of years of accumulated trust. And this might explain the contradiction we started with. Gold is no longer the standard that determines the value of your money or my money. The world successfully replaced that system, but it never replaced the reasons gold became useful in the first place. Its supply is difficult to overwhelm. It can preserve wealth without being consumed. It doesn't have to depend on another country's promise. And humanity has spent thousands of years building institutions around it. So gold doesn't survive because the gold standard survived. It survived because the gold standard was only one use for an asset that solved a much older problem. How do you preserve wealth when you don't exactly know what comes next? That is why central banks can operate a monetary system that no longer needs gold and still keep tens of thousands of tons of it sitting in their vaults. The gold standard is gone, but gold is still the standard.